For decades, the world viewed Major League Soccer as a retirement league. It was where European legends went to cash their final checks. But today, the flow of money has reversed. European powerhouses like the City Football Group and Red Bull aren't just sending aging stars. They are aggressively buying American franchises. This isn't a vanity project, it is a calculated arbitrage play. When a new team pays a $500 million expansion fee just to enter the league, you know smart money sees an opportunity. I'm going to show you the 3 financial levers driving this trend: valuation multiples, industrial talent pipelines, and the 2026 catalyst. To understand this shift, you have to look at how Wall Street analyzes sports assets. The European model is built on volatility. You spend millions on a roster, and if you have one bad season, you face relegation. Your revenue collapses and your asset value tanks. It is a high-risk gamble. The American model is the exact opposite. The MLS is a closed league. There is no relegation. Even if a team finishes last, the asset value remains protected. This stability makes MLS teams incredibly safe assets for institutional investors compared to the chaos of European football. This safety creates a massive valuation gap. Right now, MLS clubs trade at roughly 10 times their annual revenue. That is a premium multiple that rivals the NBA, which trades at 11 times revenue. European clubs rarely see those numbers because they struggle to turn a profit. In Europe, the pressure to win creates an unsustainable wage spiral. Top clubs often spend 67% of their revenue just on player salaries. It is an endless arms race that eats away at profitability. In the US, salary caps enforce financial discipline. An owner knows exactly what their maximum labor cost will be before the season starts. This creates predictable EBITDA, which is the holy grail for private equity. You aren't burning cash to avoid relegation. You are managing a controlled cost structure. Then there is the scarcity value. In open European systems, anyone can theoretically climb the ladder. In the US, the number of franchises is capped. If you want a seat at the table, you have to pay the market price. That is why San Diego FC's ownership group paid a record $500 million expansion fee. That buy-in price sets a high floor for every other team in the league. When you own one of only 30 available slots in a wealthy market, your asset appreciates simply because supply is fixed while demand grows. European investors see this clearly. They can buy a stable, high-growth asset in the US that trades at a tech-like multiple, hedging against the volatility of their own leagues. But a high valuation is just the starting point. To really understand the profit potential here, you have to look at how these ownership groups are manipulating the player market itself. High valuations are nice on paper, but the real money is made in how you use the asset to manipulate the market. This is where European investors are deploying a strategy that fundamentally changes the economics of the sport. It's called the multi-club ownership model, or MCO, and it is effectively a cheat code for bypassing the skyrocketing costs of global talent. Here is the problem with the traditional soccer business. Acquiring talent is inefficient and expensive. If a European giant like Manchester City wants to buy a developed star, they have to pay a massive transfer fee, often over $100 million plus agent commissions that can run up to 10% or more. You are buying a finished product at retail price. The MCO model flips this logic. Instead of buying the player, you buy the supply chain. Groups like City Football Group, Red Bull, and B Sports are building global networks of clubs that function as a single industrial talent pipeline. The strategy is simple: buy talent cheap and undervalued markets, develop them internally through your own system, and move them up the ladder to your flagship team. The US market is currently the most attractive node in this network, because American academies are producing high-level athletes who are undervalued compared to their European counterparts. When you own a network, you centralize your biggest cost center, intelligence. Instead of running 10 different scouting departments with 10 different budgets, an MCO runs one massive centralized data analytics operation. They can identify a 17-year-old kid in Philadelphia or Dallas using shared data, acquire him for a fraction of the cost of a European prospect, and place him in the exact right environment to grow. This creates an internal transfer market that saves millions. When a player moves from a satellite club to the main club, the money stays within the group. You aren't paying a premium to a rival owner. You aren't getting squeezed by super agents demanding huge cuts for facilitating a move between strangers. You are simply moving an asset from one pocket to another. Look at how Red Bull does this. They are the masters of the pipeline. They identified talents like Benjamin Sesko and Dominik Szoboszlai early, put them into their Austrian development hub at Salzburg, let them prove themselves, and then move them to RB Leipzig in the German Bundesliga. It is a conveyor belt of talent. City Football Group is doing the same thing. Look at the Brazilian winger Savio. He was on the books at Troyes in France, a City Group club, then moved to Girona in Spain, another City Group club where he had a breakout season. Now he's at Manchester City. If City had tried to buy him on the open market after his breakout year, he would have cost a fortune. Instead, they controlled his path the entire time. For US soccer, this is a double-edged sword. It brings in sophisticated European infrastructure and coaching, which is great for player development, but it also changes the nature of the competition. European owners aren't necessarily buying MLS teams to win the MLS Cup. They are buying them to secure a foothold in a talent-rich region. The controversial reality is that some US franchises risk becoming farm teams, development hubs where the primary goal is to prepare players for export to Europe, rather than to build a dynasty in America. Controlling talent keeps your costs down, But the reason these valuations are exploding right now is the potential for revenue to go vertical. European investors are placing a massive bet on a specific timeline, and it all converges on 2026. We have already seen the proof of concept for what happens when global attention hits the MLS. It's the Messi effect. When Lionel Messi joined Inter Miami, he didn't just sell jerseys, he fundamentally repriced the asset. In a single year, Inter Miami's valuation jumped by roughly $400 million. Their revenue more than doubled, shooting from $55 million to an estimated $127 million. But the most interesting part isn't just Miami's success. It's the spillover. When Messi plays on the road, the entire league gets paid. The Chicago Fire, a team that typically flies under the radar, generated a league record $10.5 million in gate revenue just from hosting Inter Miami for one night. Nashville pulled in nearly $10 million for a single match. This spillover benefit proves that the US market has a massive reservoir of dormant spending power that just needs the right catalyst to unlock it. European buyers believe the entire league is about to experience a Messi effect on a national scale. The structural foundation for this is the $2.5 billion deal with Apple TV+. This isn't just a broadcast contract, it's a global distribution partnership. For the first time, every MLS game is available globally without blackouts. The deal includes revenue-sharing clauses that kick in once subscription targets are met. If the league grows, the teams participate in the upside of the media platform itself, which is something traditional cable deals never offered. But the real target is the 2026 World Cup, hosted by the US, Mexico, and Canada. This is the liquidity event that smart money is front-running. The World Cup is the biggest sporting event on the planet, and it is going to flood the North American market with soccer hype, sponsorship dollars, and casual fans. History shows that domestic leagues see a massive spike in interest following a home World Cup. European clubs are buying in now because they know that by 2027 the entry price will be significantly higher. They are acquiring the assets before the hype cycle peaks. However, you have to understand the risk profile here. This is not a cash flow play. It is almost purely an equity appreciation play. The reality is that despite the high valuations, most MLS teams still operate at a loss after debt service. If you are looking for a quarterly dividend, you are in the wrong place. These European groups are burning cash operationally to hold the asset, betting that the combination of the Apple deal and the World Cup will drive the franchise values so high that the operating losses become a rounding error. They are banking on the fact that American sports franchises have historically been the most resilient asset class in the world, and they want to own the land before the skyscraper is built. European giants aren't buying US teams for charity. They are hedging against their own volatility. This is a calculated land grab for the world's most stable sports assets before the 2026 World Cup makes them unaffordable. While this capital professionalizes the league, it risks turning the MLS into a permanent feeder system for Europe's elite. If you want more deep dives into the hidden business of sports, make sure you subscribe to Revenue Racers right now.